Good afternoon, everyone. I'm Julie Bass from the Chartered Banker Institute. Thank you for joining us today for our Connecting Capital with Communities webinar with Alistair Davis, Chief Executive at Social Investment Scotland. Before I hand you over to Alistair to introduce himself, just a quick reminder that if you have any questions for Alistair throughout this session, please use the online function and he will aim to answer as many as he can prior to close today. Okay, that's all from me for now. Over to you, Alistair.
Well, thanks very much, Julie, and thank you to everybody at the Institute for the opportunity to talk to you this afternoon. It's good to be building a bit more of a relationship with the Institute to raise awareness of other models of investment rather than just banks, and I hope today that I'll be able to tell you a bit more about Social Investment Scotland as an alternative finance provider. Before getting into the guts of the presentation, I thought it would be useful just to introduce myself and talk a little bit about how I find myself here. I have actually just realised this week that this is my 15th anniversary in banking. I actually joined the profession on the 10th of September 2001, which if you were involved in the Bank of Scotland or Halifax at that particular point in time, you will remember as being merger day. But of course it was actually the day before 9/11, and that is why it will always be a trigger in my head of when my anniversary is. Initially I was a graduate trainee with Bank of Scotland and spent time working in a variety of different roles, including in the branch network and in business banking. And then I picked up my first permanent role working in business development within corporate banking in Glasgow. In 2005, I took the opportunity to join a small but growing team which was called Community Banking and moved to Edinburgh. And Community Banking was part of the bank that looked after the relationships with charities and not-for-profit organisations across the UK. And in my time there, where I was until 2009, we grew to becoming one of the largest community banking teams in the UK. That involved making social investments and lending to charities and social enterprises, but also managing deposits and day-to-day banking relationships with some of the UK's largest charities. In 2009, I was approached about joining Social Investment Scotland, and then in 2011 was appointed as Chief Executive, a role that I've now had the pleasure of holding for 5 years. So just to run through a bit about who Social Investment Scotland are and what it is that we do, I find that this particular image is particularly useful. And the presentation today largely talks about the types of investments that we make as an illustration of what it is that we do, but also focusing on the impact that we make as an organisation, the funds that we manage, and a bit about our future strategy. Social Investment Scotland is essentially an intermediary. You'll see that there we play a connecting role between different communities. And we were established in 2001, and we are also 15 years old this year. We were set up by the then Scottish Executive and the main Scottish banks as what is called a Community Development Finance Institution, or shortened to CDFI, and more confusingly now known as a responsible finance provider. But in the US, CDFIs were established to fill the gap that was not filled by the mainstream banks. In previous years it had been identified that the banks were not serving varieties of communities, either they be communities of interest or geographical communities. And there was a restriction and a compulsion placed on those banks to make sure that they were lending money into those deprived communities, and more often than not that involved capital being channelled via a network of CDFIs. So in 2001 there was a network of people who went across to the States to look at models of community investment in the USA and came back to Scotland to create Social Investment Scotland. And we were launched in 2001 with an initial £4 million of investment from the then 4 main banks in Scotland, those being Bank of Scotland, RBS, Lloyds TSB Scotland and the Clydesdale Bank. Over that time, we have gradually evolved and reshaped what it is that we do based on movements in the wider market. And we now operate under a mission statement which we say is to connect capital with communities, to make a real, measurable and sustainable impact upon people's lives. And it's that connection role that is illustrated in the diagram on this slide. We take money from a range of different investors, now being the banks, corporates, individuals and the government, and make investments into the range of different organisations that you see there. And that is the definition of social investment. It's investment that's made with the expectation of both a financial and a social return. The financial return is expected to be, at the very least, the repayment of the amount invested, but more often than not also includes an interest rate. And the social return is measured in a range of different ways depending on the outcome area, which you'll see at the bottom of that slide, that the organisation is operating in. So, for example, if they're operating in employment, training and education, then they should be making an impact in terms of creating jobs, sustaining jobs, or getting young people, for example, into training opportunities. But that connection role also happens in reverse. Social Investment Scotland is a charity and social enterprise itself, and that therefore means that we have a responsibility to help charities and social enterprises and third sector organisations understand more of what social investment is. Compared to some models of finance that they may be used to, the idea of borrowing money can be unusual. It can be something that they struggle to understand. And we carry out a range of different interventions, including workshops, guides and events to help charities and social enterprises understand what it is that they might be getting into. Over the past 15 years, we have made investments of over £50 million across 300 different facilities. So it has now been something which is reaching scale and exhibits huge potential for the future. And we'll talk a bit more about that at the end. So what I want to do now is just run through 4 examples of where we have made social investments of the type that I have mentioned, covering different examples where investment has been made for different things in different parts of Scotland and from different funds. And the first example of that is an organisation called the Glad Cafe that we have made an investment in, which is based in Shawlands in Glasgow. And this is a venue, a space which provides cultural experiences to people that visit it and a cultural impact. And that cultural impact is something that has been recognised more recently by Creative Scotland, from whom they now receive funding. We provided them with £58,000 of investment from our core capital, so that's the money that I mentioned earlier that came from the main banks. And unlike a grant, that's an investment that means that we work alongside that organisation. We still have a relationship with them despite the fact that that investment was made 4 years ago now. And it was an investment that was in the early days of the organisation, that was made alongside grants and was involved towards meeting the capital cost of the organisation and also providing them with some working capital. Now, we operate what I often call an old-fashioned banking service. That means that the relationship is face-to-face, and that means that we visit every organisation that we make an investment in before we make that investment, and we also make regular visits to them in all the time that they have a facility with us. And we believe that that just helps us get to know them that bit better and provides that charitable support to the organisation and helps us identify any issues that may come up in terms of the ongoing life of that facility. And that's a particular challenge for us being based in Edinburgh, but we do cover the whole of the country. And wherever we can, we like to try and make sure that we meet organisations face to face. The second organisation that I wanted to highlight is an investment from a different fund. This was an investment from something called the Scottish Investment Fund, and that came from the Scottish Government in 2007-8. And basically that was a recognition that they wanted to encourage the third sector in Scotland to be more enterprising, to generate more of its income from its own resources and be less reliant on government grants. And obviously, although that was developed in 2007, that was perhaps with a certain degree of foresight given what was going to happen with the financial crash thereafter. The Scottish Investment Fund was a £31.8 million programme of investment It was a mix of loan and grant towards these organisations, and was invested in 67 organisations across Scotland with amounts of anywhere between £100,000 and £1 million. Showcase the Street is an organisation in Dundee who received £170,000 of investment from that fund. Showcase the Street are a particularly impressive social enterprise that were established by a social entrepreneur from Dundee who had retired from the police and was determined to do something for the local community where local people, and in this case local kids, were given the opportunity to participate in activities that they were interested in. And what that social entrepreneur called Fergus had identified was that there was plenty of provision, particularly for boys who wanted to play football, but for girls there wasn't the same level of provision in Dundee. And from small roots in our growth, Showcase the Street now provides street dance classes across 13 towns and cities, largely in Dundee and Tayside. In 2013, alongside other funders, they approached Social Investment Scotland for funding towards the purchase price of a building in Dundee that would provide a permanent home for classes and other activities. And actually later on was expanded to include an indoor football pitch as well. And this is quite a common reason why an organisation may choose to raise social investment, i.e. to purchase an asset. It's a good thing for third sector organisations to have an asset on their balance sheet that they can use for future investment, provides them with a greater degree of stability. And in this situation, we were working with a range of other funders as part of a mix of funding, which again is not unusual in terms of the proposals that we look at, to put together an investment package for this organisation. Obviously, the particular social impact there is clear. You can see it from the smiling faces of the kids that participate in those activities. And absolutely, it's been a way of making sure that children are safe, not on the streets, and participating in physical activity. The third investment that I wanted to highlight today is also in Dundee, and an organisation called the Factory Skate Park. And the Factory Skate Park have actually been one of our longest standing customers, first borrowing money from Social Investment Scotland back in 2005. Again, a social entrepreneur, this time called Derek, was keen to try and find a way of engaging with young people in Dundee, and actually led a long process of community consultation to find out what it was that young people actually wanted from their local community. What they actually wanted was a skate park, and the Factory Skate Park was the first purpose-built indoor skate park anywhere in the UK. Alongside providing, again, a safe place where kids could play and engage in physical activity. They also provided space where they could do their homework, but also providing space where pensioners and older people could learn how to use computers, but taught by the young people. And that intergenerational work is one of the things for which they are now particularly well known. The enterprise model, of course, comes from the fact that people can go in and pay to use the space, particularly at evenings and weekends. But after school and during the day and in the school holidays, young people can use the facilities free of charge. We've had 3 rounds of investment in Factory Skate Park after that initial investment towards the construction costs of the building that you see in the pictures on that slide. In 2011-12, they also received an investment from the Scottish Investment Fund towards the construction costs and working capital costs of a soft play facility on a site next to the Factory Skate Park in Dundee. There being no soft play, or very limited soft play provision in Dundee, in a particularly deprived community where there were a number of mothers with basically nowhere to go. That also created various employment and training opportunities for people within that community. And soft play is a great way of making cash. It's a very sustainable business model. It's a popular facility, and it's been a great way to allow the Factory Skate Park to build their sustainability rather than being reliant on funding from either Scottish Government, local authority or trusts and foundations. The third round of investment was much more recently in 2014, the £300,000 that's highlighted there. And that was from another fund that we launched that same year called the Social Growth Fund. And that's a fund that is focused on scale and growth of social enterprises. And what the fund allowed Factory Skate Park to do was purchase their only soft play competitor in Dundee to acquire another business and turn it into a social enterprise. And in combination, all of these different enterprises allow this organisation to deliver social impact that is sustainable via trading activity and not reliant on funding from other resources. And the fourth and final organisation I wanted to highlight as what we do at Social Investment Scotland is an organisation a bit further north in Aberdeen, which is also known as Aberdeen Foyer, and actually an organisation that used to sit within my portfolio when I worked at the Bank of Scotland. So actually an organisation I've worked with on and off for around about 10 years now. They were set up, again, based on local need, to provide solutions, particularly for young people that were finding themselves in a situation of homelessness. Aberdeen, as we are all aware, is an area where there is real wealth, but also real areas of deprivation. And the foyer were set up as a response to that, providing education, training opportunities, counselling services and health support to these young people based on the foyer model, which is used in other towns and cities across the UK. Alongside those services, which are funded in a relatively traditional way under service level agreement from the local authority and others, they also have a collection of social enterprises. They have a graphic design business called Foyer Graphics. They actually have the only social enterprise driver training organisation in the UK called Roadwise. Again, that was developed in response to the particularly high number of road deaths in the North East, particularly amongst young people. And also a social enterprise called Foyer Works, which provides property maintenance services to social housing and factor developments in Aberdeen and Aberdeenshire. Now, as well as providing sustainable sources of income for Aberdeen Foyer, these businesses also provide placement opportunities for young people, not just the ones who are finding themselves in difficult situations as a result of finding themselves homeless, but also for other young people, perhaps in partnership with organisations like the Prince's Trust. Aberdeen Foyer have taken on social investment throughout their development, and in 2012, again as part of the Scottish Investment Fund, received an overall investment package of £600,000 from SIS, and that investment was used in a range of different ways to sustain a range of different parts of their business, but particularly towards the further development of Roadwise driver trading. And of course their social impact is clear in terms of the opportunities that they bring to the young people of Aberdeen and Aberdeenshire. So I mentioned earlier that social investment was not just about driving a financial return, it's also about the fulfilment of our own mission and being able to tell the story of our own social impact. And this is what makes social investment a bit more interesting than conventional banking or conventional investment. And every year, as part of an annual survey process, we make an attempt using evolving methodologies to tell the story of our social impact. And what we do is we do that in two ways. We do that through looking at social impact at a beneficiary level, and that involves looking right down at the level of the individuals who the organisations that we work with support, and trying to uncover the difference that we have made. Now, that's not a perfect methodology. It's obviously difficult when we make investments across a range of different outcome areas, but what we do know, based on our most recent survey, which was in 2015, is that, as you see there, a third of the beneficiaries live in the most deprived areas, as defined by the Scottish Index of Multiple Deprivation, and the updated postcodes for that were of course released in the last 2 weeks. But also we're able to tell that 51% of the beneficiaries of the organisations that we work with are children, young people and families, and 48% are people who are experiencing long-term unemployment. And you'll be able to tell from the different examples that I've given today how those particular organisations are working with these particular beneficiary groups. We are also interested, of course, in the economic impact of our activity. And what you can see there is that the social enterprises that we support with our social investment employ just under 6,300 people. And in the year to March 2015, we created 454 jobs as a direct consequence of the organisations that we work with taking on that investment. The key thing that we're trying to do, and that's in line with the objectives of social investment, is make sure that the social impact that the organisations that we invest in is sustainable, and therefore they are not vulnerable or not as vulnerable to changes in spending in the public sector. And I think we're all aware that there are challenges in terms of what the public sector is able to spend on activities such as those supported by the social enterprises that we work with. And that's why we're particularly keen to ensure that the turnover of these organisations we work with is supported by trading activity, i.e. activity that is generated from their own resources rather than from grants. And that pattern that we see there is something that has been evolving over the 5 or so years that we've been doing this exercise, and has continued to be the case in the 2016 report, which we expect to publish within the next month. The next slide covers the diversity of the range of different funds that we manage and how that money is put together. We now operate 5 main programmes of investment which contribute towards the overall cost and sustainability of Social Investment Scotland itself. And just running through the different funds that you see highlighted on that slide there. The first one in the top left-hand corner is our Community Finance Fund. And this is the money that we borrow from the banks that I highlighted at the start. Those 4 main banks are now 3, following the merger between Lloyds TSB and the Bank of Scotland. So we now have a £1 million commitment from Lloyds Banking Group, which is supplemented by a £500,000 commitment from RBS and a £500,000 commitment from Clydesdale or National Australia Group. And those are commitments that we have held and managed since they were originally invested in SIS, and more recently have been joined by a further £2 million investment from Triodos Bank, the Dutch ethical bank. And they invest money in SIS under a tax relief which is called Community Investment Tax Relief, which is open to all corporate organisations, but in particular banks, and offers investors tax relief based on the equivalent amount of their investment in organisations like SIS. Basically, we are able to borrow that money at low cost, lend it out at a margin, with the difference meeting the operating costs of that particular fund. Now, I think the thing that is interesting to note is that despite Social Investment Scotland making investments that are beyond the parameters of the mainstream banks, our bad debt levels are actually very low. And over the past 15 years, the write-offs on that particular portfolio have been less than 5%, which obviously contrasts with the experience of the mainstream lenders who would probably give their eye teeth to have bad debt levels that were that low. So that's our core on-balance sheet capital that we continue to manage and are able to offer on an ongoing basis. I've mentioned moving down on that slide to the bottom left-hand corner, the Scottish Investment Fund, the Scottish Government Fund that we continue to manage. That capital is now completely subscribed, and our work there is about managing that back book of investment to make sure that as much as possible of that original investment capital is repaid, because what we now do with that repaid investment capital is use it to fund the commitment to the fund that is mentioned within the middle of that page, the Social Growth Fund, which allows us to make investments at a higher level than what we're able to make from our core on-balance sheet capital, indeed up to £1 million. And that fund has the investment from the Scottish Government, from the Scottish Investment Fund, of £8 million, but also an equivalent commitment, again, a further £8 million to make a £16 million fund from an organisation called Big Society Capital. Now, despite the name, Big Society Capital are an independent institution. They are a social investment wholesale bank, in effect, who operate across the UK. And they have £600 million of capital available to invest in organisations like Social Investment Scotland. £400 million of that capital comes from the English dormant bank account monies. The Scottish monies are used in a different way, but it is supplemented by a £200 million investment from the Project Merlin banks, and that's the four banks who received financial support from the Treasury during the financial crash. And in exchange for that support, they were asked to make a £50 million commitment each into Big Society Capital to sustain the development and emergence of this new social investment industry. Social Investment Scotland are Big Society Capital's only commitment to date in Scotland. Indeed, we are their only commitment outside of England. And our track record so far has shown that we're being able to invest that capital quicker than anywhere else in the UK, mainly because there is a defined and quite sophisticated social enterprise community, well supported by an ecosystem of support. And also, I believe, the credibility of an investment manager like Social Investment Scotland, who is well established within the social enterprise community in Scotland. The two funds on the right-hand side of the slide there are the two more recent initiatives that we have launched, but perhaps the most interesting in terms of where the capital has come from. I'll talk about SIS Community Capital in a bit more detail with information that's presented on the next slide. But one of the most interesting initiatives that we've had the pleasure of being involved with in the past couple of years is an emerging relationship with ASDA. ASDA being the UK brand, of course, of the largest retailer in the world, Walmart. And basically what this relationship has meant is that every time a Carrier bag is sold in an Asda supermarket in Scotland and now Wales, so that 5p that you pay if you forget to take your bag to the supermarket actually now comes to Social Investment Scotland. And we lend that money to charities and social enterprises in Scotland. That whole initiative was driven out of the desire of ASDA to make sure that, despite the fact that the expectation was that those monies would go down as people's behaviours changed, that the pot of money was able to be sustained and replenished. And so with the money being lent out, it means that that money can continually be recycled into other charities and social enterprises in the future. So we've used that to develop a new, more affordable product that's aimed at organisations who are taking on investment for the first time. And this year we expanded the relationship when we were asked to manage all of the revenue from Scotland to develop a new initiative called the ASDA Social Enterprise Supplier Development Academy. And basically that builds on ASDA's work for mainstream businesses to provide opportunities for social enterprises who produce product to get access to the ASDA shelves. We believe in social enterprise as a business model, but we believe that not enough people in the street, or the man in the street, actually knows what a social enterprise is. But we believe that if consumers were given the opportunity to purchase products from social enterprises in the same way as that you can choose to purchase products that are fair trade, that would do a lot to raise awareness of the business model of social enterprise. And we took 12 social enterprises to ASDA House in Leeds this year to allow them to learn more about the opportunities of mainstream mass market retailer. And all I will say is watch this space for some social enterprises that will reach the shelves of supermarkets soon. And that is activity that we hope to not only continue but build on in 2017 and hopefully beyond. It's one of the first examples anywhere in the world of a corporate providing capital for social investment through an intermediary like SIS. And the fifth and final fund, which is actually at the moment committed, is a new initiative called SIS Community Capital. And just to explain what that is, many of you will be familiar with the tax reliefs that are available for enterprise activity, namely SEIS and EIS. And what Social Investment Tax Relief, or SITR, seeks to do is to provide an opportunity for social enterprises to raise investment from individual investors. There was an anomaly that had been emerged in line with the development of social enterprise as a business model that meant that ordinary businesses could raise capital from individual investors, and those individual investors could attract tax relief. But if an individual investor wanted to make an investment in a social enterprise, the same tax relief was not available to them. The UK government, through the Treasury, sought to rectify this anomaly and introduced social investment tax relief. And SIS was the first organisation anywhere in the UK to launch an SITR co-investment fund that allowed a range of investors to put money into a pot, and for that money then to be invested by an expert intermediary like SIS. Last year we raised £400,000 from 27 investors, some of the first examples of individual investors making investments into social enterprises. And that money was invested, again at lower cost, in 7 social enterprises right across Scotland. It's certainly something to watch this space on. We believe it exhibits huge potential for the funding of social enterprises going forward, and is certainly activity that we're looking to see how we might continue to grow in the future. So that does underpin quite an exciting new strategy for social investment for Scotland, which we have called 20 by 2020. And that sets out 20 ambitious priorities for social investment Scotland over the next 4 years. We certainly want to continue to provide more investment and support along the same lines as what we do at the moment, but we really want to use the foundation and the success that we've built up over the past 4 or 5 years as a platform for future growth. We believe in social enterprise as a business model of choice, and we want to see it grow in prominence in the Scottish economy. And we believe that it will particularly resonate for the Scottish Government in a business and an economic strategy that focuses on inclusive growth, and we see social enterprise playing a huge role at the heart of that activity. The second thing that we hope to do is to create opportunities for social enterprises that may then lead on to investment, so things like the work with ASDA, to stimulate opportunities for social enterprises to sell and grow their social enterprises, and then take on investment from SIS to support that growth. Our third headline priority is about working more explicitly with young people who we believe are particularly interested in social enterprise as a business model. It's something that resonates with their values, particularly following the financial crash. We want social enterprises like SIS to be seen as a place where people can not only develop their careers, but where people can develop business models that resonate not only with their objectives to make money, but to do that in a way that creates either a social or an environmental impact. And the fourth headline priority that we seek to identify as part of our future strategy is to explore how social enterprise and social investment can play a greater role in the whole area of public sector reform. It is quite clear to us all that there is growing need but diminishing resources, and we believe that the social enterprise business model will create opportunities to provide public services, but in a way that doesn't necessarily involve resources from the state. So, for example, can childcare provision be delivered by a social enterprise rather than by the state directly? And there are other ways in which social impact can be delivered by social enterprises without it necessarily having to be delivered by public sector organisations. So hopefully that's provided a good roundup of what social investment Scotland is and the types of things that we do and what we plan to do in the future. But I now welcome the opportunity to answer some of your questions.
Thank you, Alistair, for the very informative presentation today. Just quickly, before we address the questions, should anyone require a copy of the slides from today's presentation, you can download these from the Attachments tab, along with some further material that you may find useful. Okay, Alistair, we've got 3 questions that have come through here today. The first question is surrounding competition. Do you actively compete with the banks?
We don't actively compete with the banks. Obviously, there are banks that I have mentioned that form part of our investment capital, but really our whole ethos as an organisation is to provide finance where other organisations don't. And we would actively encourage an organisation who approached us for finance to think about whether they could actually raise money from other sources. Now, that doesn't always mean it could be a bank, but it could be maybe from organisations like the Big Lottery or other trusts and foundations, because obviously the more money that an organisation can raise from those sources reduces the amount that they overall have to borrow. So if, for example, an organisation approached us because they were considering buying an asset and we knew that there would be the opportunity to raise some bank debt against that, then we would encourage them to speak to either their own bank or other banks as part of that process. And the advantage that we have in terms of having a number of investment managers who come from a banking background is being able to identify where a bank may be able to help. So we would always seek to signpost and engage with other funders rather than competing directly with the banks. That's not part of our reason for existing. But obviously some of the things that we fund, and indeed some of the things that we have mentioned today, would not necessarily be activities or business models or things that banks were able to fund, either because they were seen to be too high risk or they were looking for investment on an unsecured basis. And we have considerable flexibility to lend based on viability and affordability rather than on a fixed lending policy. And that means that for that reason, we're not competing with the banks either.
Okay, great. Thank you. The next question is surrounding secured loans. Do you take security for your loans?
Where there is security available for a loan, and where it may even be behind a senior lender, we would take that security. We are not a lender that would seek to ever proactively recover our security. Obviously, as I'm sure as listeners would imagine, it would not be the best PR for Social Investment Scotland if we were seen to be putting a charity out of its building, for example. But the reason we take security where it is available is that our funds obviously come from a variety of sources, and we like to maximise, of course, the amount that is being repaid or is available for reinvestment into other organisations in the future. So we would take that security if it was available, and also to give us more control where things did go wrong. And things do go wrong. This is not obviously a situation where everything works perfectly all the time. But that would mean that in such an instance we would be able to either reclaim or sell that asset to seek some repayment, often not for all that we were owed, to put some money back into the pot to lend to other organisations. And where that security was available, therefore suggesting a lower risk loan, then the organisation would be rewarded with a slightly lower interest rate on that particular facility.
Thanks, Alistair. The third question was surrounding the cost of capital. Why are loans from Social Investment Scotland so expensive?
So that's a good question, and one that we're regularly asked by organisations, and a question that is quite commonly raised as being the biggest drawback of social investment. Obviously, looking at it in terms of black and white, it is much higher than what you would pay if you were borrowing money either for your own mortgage or from a commercial lender for commercial purposes. But we have a cost of capital in many of our facilities ourselves, and we have to cover that. We have to ensure that our operations ourselves are sustainable and not reliant on government grants. But we are obviously a charity and social enterprise. We don't exist to make huge surpluses. We certainly are not paying out huge bonuses. So we generally try to make sure that we try and keep the cost of capital in our different funds as low as possible. And one of my missions in terms of the running of Social Investment Scotland is to attract the type of capital that then allows us to pass on savings to social enterprises so they're able to borrow money at a cheaper rate. And I think you see that from the examples that I've mentioned today in terms of our relationships with ASDA and also from individual investors, which have allowed us to raise money that's cheaper than that from other sources that we work with. And we're able to pass that saving directly on to charities and social enterprises, which also obviously allows them to spend less on servicing investment and more on the delivery of social impact.
Okay, thanks, Alistair. I've got one last-minute question that's just come through as well. Do you have any links or collaboration with community lenders who lend to individuals? And if so, is that model something you endorse?
So there is a network of community development financial institutions or responsible finance providers who work with a range of different communities. Just like I mentioned, is what happens in the US. And there are organisations like CIS across the UK and in Scotland who work with individuals who are unable to access credit, SMEs who are unable to access loan finance, and charities and social enterprises who are unable to access investment, like what we do at Social Investment Scotland. We enjoy good relationships with organisations through our membership of Responsible Finance, which is the trade body for organisations like CIS, where I also sit on the board. And in particular, in a Scottish context, we have a good relationship with ScotCash, who at the moment operate in Glasgow, and provide credit to individuals who are financially excluded and actually unable to access facilities from credit unions because of the lack of deposits, but providing an alternative to either doorstep lenders like the Provident and also, of course, the more mainstream lenders, people like Wonga, and doing things in an ethical way. And that certainly is something that I believe presents a huge opportunity for the growth of this responsible finance movement, to make sure that everybody has access to affordable credit and isn't forced into taking high-cost credit from alternative finance providers. So it's certainly something I would watch this space on.
Great, thanks, Alistair. You've certainly given us some great points to take away and think about today. I'd just like to ask one final favour of our audience to please remember to give us a rating and feedback on today's session so that we can keep delivering what you'd like to hear. Also, should anybody like to listen back or recommend this webcast to colleagues, it will be available from the original link that was in the previous invitation. So thanks again, Alistair. We really appreciate you taking the time to share your insights and advice today. Also, thanks to everyone at home for joining us. Have a great day, everyone. Goodbye.